For nearly 3 decades, Plug Power Inc. has really been the name you heard when people talk seriously about a clean hydrogen future.
The bellwether, really.
Exactly. The original bellwether. They had the blue chip customers. I mean, think Amazon, Walmart, and what seemed like unbeatable state-of-the-art technology.
But if you track the financial sources now, the story has just fundamentally changed. Plug Power is in a fight for survival. They're in the middle of this frantic, high-stakes pivot.
It's a classic case study.
It is. It shows you how having revolutionary tech doesn't guarantee a functioning balance sheet, especially when the whole macro climate shifts under your feet.
So our mission today is to give you a real deep dive into this turnaround effort. We're going to explore how this hydrogen pioneer ended up facing, well, a liquidity crisis.
And how it's now scrambling really urgently to leverage the AI data center boom just to stay solvent.
They're moving from what they called hypergrowth.
The whole growth at all costs philosophy.
Right. And now they're in this aggressive operational rationalization phase. Internal reports, our sources cite, have branded this massive shift Project Quantum Leap.
And the stakes could not be higher, not just for the company, but for the whole green hydrogen industry that's watching them.
Okay, let's unpack this. Let's start with the original vision, the hydrogen promise. We all know heavy batteries just can't cut it in certain sectors.
The hard-to-abate ones, yeah. Long-haul transport, heavy logistics, the weight, the charging downtime, it's just not practical.
And hydrogen, being this clean, energy-dense carrier, was really hailed as the only scalable alternative.
And Plug Power was, I have to say, brilliant in finding their initial sweet spot. They didn't go after the whole transport market. They targeted a very specific, very sticky niche.
Material handling.
Exactly. Material handling. Just picture one of Amazon's or Walmart's massive 147 distribution centers. I mean, time is literally money there.
And that was the core value proposition, right? A battery forklift might take 6, maybe 8 hours to charge.
Or you need this whole complex, messy battery swapping infrastructure. It's a nightmare.
Whereas their hydrogen fuel cell systems, their Gen Drive, could be refueled in, what was it, 2 minutes?
2 minutes. That kind of non-stop operational efficiency, that created incredible customer stickiness. It was their whole ecosystem lock-in with their Gen Fuel solutions.
But that success, it fueled a massive and, as it turns out, a really risky ambition.
Vertical integration.
They decided they weren't just going to sell the fuel cells anymore.
Nope. They were going to be an energy utility, too, control the whole chain.
Right, from producing the hydrogen to liquefying it, transporting it, dispensing it themselves. This meant announcing these massive chemical plants like that flagship facility down in Woodbine, Georgia.
And this is the exact moment, and it's so key for you to understand this. This is where the risk just exponentially increased.
How so?
Because building chemical and energy infrastructure, electrolyzers, liquefaction plants, all of it is just astronomically capital intensive. It transformed Plug from a relatively asset-light manufacturer
into a heavy capital energy utility.
Precisely. And if you look at the timeline, this big transformation happened just as the macroeconomic environment did a complete 180.
The end of the zero interest rate policy era.
Exactly. They started building these multi-hundred-million-dollar plants when money was basically free, maybe 1 or 2%. By the time costs ballooned and timelines stretched, they were suddenly trying to finance these things with capital costing 7, 8% or even more.
So the strategy that was meant to secure their future
became an existential financial drag almost overnight.
Which brings us right to the core problem, the thing that forced this entire pivot, the gross margin nightmare. Looking at the financials, this is the number. Q1 2025, a disastrous gross margin loss of negative 55%.
Okay, so let's unpack that for a second. A negative 55% margin.
What does that actually mean?
It means for every single dollar of revenue the company generated, they spent $1.55 to deliver that product or service. I mean, you're structurally losing money on every single transaction. You can't survive that way.
So the question is why? If they had this vertical integration plan, shouldn't they have been protected?
Ah, that's the catch. The sources really highlight this massive fuel delivery pain point. They sign these long-term contracts with their big customers, Amazon, Walmart.
To get them hooked on the tech.
Exactly. They gave them fixed, very favorable prices on the hydrogen fuel itself to ensure that sticky adoption. And you can't just break those contracts.
So the plan was to fulfill those cheap contracts with their own cheap Internally produced hydrogen.
That was absolutely the plan. But because their own production facilities didn't come online fast enough or at scale, because all those capital cost overruns and delays,
They had to go and buy it.
they were forced to buy expensive third-party hydrogen on the spot market and then turn around and resell it at a huge contractual loss just to keep Amazon's forklifts running.
It's a vicious cycle.
Hmm.
And that led to a severe liquidity red alert.
And the numbers just bear that out. The cash burn was terrifying.
In Q3 2025 alone, net cash used in operations was still hovering around $90 million. But here's the kicker. The company ended that quarter with only $166 million in unrestricted cash. At that burn rate, they had less than 2 quarters of runway left.
And you also saw management doing what you call clearing the decks. They took $226 million in non-cash impairment charges in Q3.
Which means writing down the value add assets.
Yeah, writing down equipment, projects, things that are just no longer worth what they paid for them. It's about reflecting reality on the balance sheet before you make a massive strategic change.
So that need for immediate solvency, it forced a pretty desperate maneuver in late 2025. They did a massive refinancing.
Right. They raised nearly $400 million by issuing convertible senior notes.
The coupon, the interest rate, was 6.75%, which honestly doesn't sound too bad in this environment.
Well, it was a successful defensive move. They immediately used that cash to retire some much older, much more expensive, and frankly, toxic 15% secured debt.
Secured debt is the dangerous kind.
It's the most dangerous. It means if you default, the lenders can just start seizing company assets. So retiring that debt was critical for their immediate survival.
But there's always a trade-off. What was the price for these new lower rate notes?
Future dilution. That's always the trade-off. The notes are convertible.
Meaning investors can swap the debt for stock.
Right. They accepted a lower interest rate because they got the option to convert that debt into millions of new Plug Power shares if the stock price goes up. This creates a massive overhang, meaning solvency today comes at the cost of a severe risk of shareholder dilution down the line.
And just to compound all this financial stress, the big one, the suspension of that much-anticipated $1.66 billion Department of Energy loan.
That was supposed to be the cheap, federally backed money, the cornerstone for their expansion.
And losing it just pulled the rug out.
Yeah. It completely pulled the rug out. Losing that guaranteed low-cost capital meant they had to abruptly abandon that massive-scale build-out they'd planned and just scramble for immediate cash from much more expensive private sources. That failure is really the primary catalyst for this whole pivot.
Which brings us to the pivot itself. Since they can't get cheap government money for their long-term dream, they have to chase the one market that's exploding and needs power now.
The AI data center market.
It's a genuine opportunity, driven by a pure infrastructure bottleneck.
Absolutely. AI workloads are creating this insatiable, unprecedented demand for electricity. I mean, the grid just cannot keep up. Data center operators are facing 3, 4, 5-year wait times just for a new substation.
They need power now, and they need cleaner backup solutions than the huge arrays of dirty diesel generators they all rely on.
And that is Plug Power's pitch. They're positioning their PM fuel cells proton exchange membrane to be the ideal replacement for those diesel generators. And this isn't just theory. They successfully piloted a 3-megawatt backup system with a major player, Microsoft.
Now, this requires a really critical distinction because I think a lot of people confuse Plug Power with their main rival, Bloom Energy.
It's a very important distinction. Different tech, different applications.
What's the key difference?
It comes down to speed and fuel purity. Plug uses PEM technology. Bloom uses SOFC, solid oxide fuel cell technology. They're going after fundamentally different problems.
Okay, let's start with Plug. PEM technology.
Incredibly fast startup. You're talking seconds or minutes, not hours. Perfect for emergency backup when the grid instantly fails. The catch is PEM requires very high purity liquid hydrogen.
And that purity requirement brings us right back to the gross margin problem.
It all connects. That's what drove the whole vertical integration strategy in the first place. If you don't control the production of that expensive, pure fuel, you are always vulnerable to cost spikes.
Okay, so contrast that with Bloom's SOFC tech.
Much slower startup, hours, even days. But, and this is the key, it runs primarily on readily available natural gas. It's designed for baseload power.
Meaning it runs all the time.
Continuously. It competes with the electric utility grid itself as a decentralized power source. So Bloom is trying to be the clean power plant. Plug, with its new pivot, is trying to be the clean, quick emergency generator.
Their competition isn't the utility grid then.
No. Their competition is Caterpillar and Cummins, the huge players who dominate the diesel generator market. It's a different but enormous opportunity.
Still, the urgency of this pivot, the desperation for cash, you can really see it in some of the recent operational moves, like that strategic retreat in November 2025.
Oh, yes. The deal to sell electricity rights and infrastructure to a data center developer.
For about $275 million.
This is a huge signal, a real point of concern for analysts. They aren't selling fuel cells. They're selling real estate and valuable grid connection rights. The actual assets they had secured for their own hydrogen plants, like the Stamp project up in New York.
It really feels like a capitulation on that vertical integration dream.
It is. I mean, it's the company needing immediate, non-dilutive cash to survive, but they're doing it by retreating from building the very internal hydrogen capacity they need to fix the negative fuel margins long-term.
It's a short-term fix.
One analysis we saw called it selling the seed corn to buy dinner.
So speaking of production, what is the status of that core margin fix? Are they actually manufacturing their own cheap hydrogen?
Well, there's one qualified success story that keeps the bull case alive, and that's the Woodbine, Georgia plant.
The flagship.
The flagship. That facility hit 97% uptime in August 2025. It produced 324 metric tons of liquid hydrogen. It proves the core electrolyzer technology works at scale.
But one success is overshadowed by a stalled pipeline.
Completely. Other key projects, like Project Limestone in Texas, are suspended. The New York infrastructure was just sold off for cash. This caps their current internal production at roughly 40 tons per day.
Which isn't enough.
Not nearly enough. Their demand from Amazon and Walmart alone far exceeds that, so their structural reliance on expensive third-party hydrogen is going to persist.
And we can't ignore the leadership change here. The face of the company for 16 years, Andy Marsh, is stepping down in early 2026.
To be succeeded by Jose Luis Crespo. This transition is really symbolic of the whole pivot. Marsh was the visionary, always focused on expansion, market capture.
Growth at all costs.
Yes. Crespo is the incoming operator. He's focused on execution, sales discipline, and the deep cost cuts from Project Quantum Leap. It's the official end of that growth mentality and the start of focusing only on profitable transactions.
But our sources also highlight the human cost. Multiple rounds of layoffs, low employee morale. The feedback suggests internal chaos, a real disconnect between the executive hype and the budget-constrained reality on the factory floor.
The turnaround is being executed under just immense pressure from inside and out.
So what does this all mean for you, the listener, looking at the future of Plug Power? It really remains a fiercely binary proposition. The underlying tech works.
It works. And the customers are sticky. They are addicted to that 2-minute refueling advantage. And the market demand, especially for clean backup power, is growing exponentially. But the capital structure is fractured. The dilution risk is severe. The bull case really relies entirely on Crespo, ruthlessly executing on cost cuts. The Georgia plant finally flipping those fuel margins positive. And the data center pivot succeeding commercially and fast.
And the bear case, on the other hand, sees the dilution spiral continuing. It sees asset sales as just unsustainable one-time cash fixes, and the cash burn just keeps going until the well runs dry.
You know, Plug Power successfully built the vision of a vertically integrated hydrogen economy. But with the visionary gone and key pieces of that vision sold off for immediate cash, the question for you to consider is this. Can the new leadership succeed by shrinking that grand vision and focusing entirely on cold, hard manufacturing efficiency and capital discipline? Is survival now more about disciplined bookkeeping than it is about breakthrough technology?